A fiscally dominant environment is a run it hot environment. So generally you get higher nominal GDP growth than you'd otherwise expect. Generally better nominally performing asset prices than you generally expect. Like as an extreme example, if you look at an emerging market recession, a lot of times their equities will go up in their local currency because their local currency is so weak. It's a little bit different in a developed market, but when you have a developed market that's in stagflation, it's kind of this more fiscally dominant environment rather than a private sector credit contraction, you tend to get these like emerging market characteristics in a developed market, just less extreme. And so generally speaking, prices surprise to the upside, including asset prices. And, if you're worried about certain risks, like we talked before about how tariffs could negatively impact US corporate margins, well, that's where assets like gold and Bitcoin or certain foreign equities can be helpful. And so I generally expect that, the next 5 years is still generally an environment where you want to own more equities or more scarce assets than you do want to own bonds or cash, with maybe a minor caveat that non-US equities are probably increasing in attractiveness here compared to US equities, but it's very industry specific, very stock specific, and very asset specific. But all else being equal, I want to own assets that are more built for a run it hot environment, which is things that are not paper. That's another issue with the whole fiscal dominance thing in general, is that people often think that if you do austerity, it can fix it. And austerity certainly helps prevent it from getting to where it is now. But once it's where it's at now, even attempts at austerity alone tend to fail, because if you reduce the deficit one way or another, let's say you increase taxes, including tariffs or elsewhere, or you reduce spending somewhere substantially, generally speaking, that's going to impact like the stock market. And that's going to, with a lag, give you weaker capital gains taxes. And the US is far more reliant on the stock market for overall tax revenue than most other Western nations. We're more financialized is probably the term to think of. And that's for two main reasons. One is our stock market relative to GDP is quite high because it's a global stock market. There's capital from all around the world invested in our stock market, more so than other countries. We have some of the biggest, most diversified markets, companies in the world. And two, there's the big factor that a larger portion of US executive compensation is from stock issuance, option issuance, that sort of thing, compared to, for example, Europe. So the combination of high wealth concentration and a lot of stock-based compensation means that when you get a flat or down year or two in the stock market, that does tend to impact, high net worth paychecks pretty significantly, and therefore with a lag impacts tax revenue as well. So it's a very complicated Gordian knot to try to untie, which is why I don't really expect it to be untied in a investable time horizon. People often think that all countries are going to go the way of Japan. There are two really unique things about Japan. One, they were the first to get there at size. They're like the oldest nation on average in terms of like median age and demographics cliffs. And the sheer size of their bubble in the late 80s and early 90s was massive, and they therefore provided them with a massive runway for deflation. In addition, they reached that whole period in the 2010s decade, that after they got past the initial bubble, and then they're more in like their printing phase. So it was really into late 2012 is when you look at the Bank of Japan's balance sheet, it went vertical basically. There was like the whole Abenomics period starting in the late 2012. And so for about a decade, you have this kind of massive central bank balance sheet growth. But that 2010s decade was during a commodity bear market. So that was when the Chinese economy slowed down. So we had a commodity bull market during the 2000s decade. That was the emerging market boom. That was when BRICS got their acronym because that was the place you wanted to invest. That was the big commodity bull market. The 2010s, you had these really big deflationary offsets because China was a very deflationary force with its, rapid growth of manufacturing capability, and then its kind of reduction in, stress in commodity markets. That whole commodity bear market was disinflationary. And so Japan had tons of leeway to do a lot of this without it being inflationary. And then two, they're a current account surplus nation. So they spent decades running trade surpluses. They built up a positive net international investment position, meaning they own more foreign assets than foreigners own of their assets. So they have a big stream of interest and dividends that flow to them every year. And a lot of that offsets currency weakness and offsets monetized fiscal deficits. The US is entering this stage with both of those things reversed. Now we're entering a more protectionist trade environment. So we no longer really have the world kind of providing a disinflationary backdrop to us. And two, we have a structural trade deficit, which is what the tariffs are about. And so all else being equal, the US situation is likely to look hotter than the Japanese situation. So instead of kind of prolonged near zero inflation and asset price, deflation the whole time, kind of offsetting all the money printing, you're more likely to get either consumer prices and or asset prices keeping up with that money supply growth because it's a hotter environment. And anything that hurts productivity is more likely to make some of that show up in CPI. And anything that's really good for productivity, so keeping the energy flowing, all the gains from AI and efficiency gains there, then it's more likely to instead push that into asset prices. The supplementary leverage ratio, that potentially allows banks to hold more treasuries than they otherwise would. If you go back and look at the World War II era, which was the last time that the developed world had this much debt to GDP, the big warehouse for it was banks. Like in the US, like something like 25% of all public debt was stuffed into the banking system. And the sheer percentage of their assets that consisted of US debt was the highest it ever was in like the 40s and then subsequently in the 50s and 60s. These kind of stuff it all into banks and the fractional reserve banking system. So a lower supplementary leverage ratio, all else being equal, lets more be stuffed into banks. But then in addition, things like the standing repo facility that the Fed has increases the fungibility between cash and treasuries. And basically, banks know that if they find themselves holding too much treasuries and not enough liquidity, they have this standing facility from the central bank that they can temporarily give them their treasuries and get cash. And at the end of quarter two, that facility was tapped for $11 billion for the first time in like 2 quarters. And it was the biggest usage of it in years. Now, it's still kind of small in the grand scheme of things, but standing facilities like that increase fungibility between all these different types of assets, these safe collateral, and therefore, extend the runway, extend the tracks for how long they can run these types of fiscally dominant environments. On average, like let's call it a 5-year time horizon, I find emerging markets pretty attractive. They're not without risk for sure. But when you look at them as a group, you can spread out risk. And they've been in basically a 15-year cycle of underperformance. Makes sense because it's been a strong dollar environment. And they started that period overvalued. But now they're very cheap, very under-owned. In many cases, they have higher real rates than the US, higher nominal rates. And, in general, pockets of Latin America, pockets of Eastern Europe, pockets of Southeast Asia, many of those markets are attractive. In addition to, non-equity assets like gold or Bitcoin, some of those cash flowing emerging markets are interesting. I don't really expect too much financial oppression to hit the US banking system in the next 3 to 5 years. It means I don't place a very high probability on it. So I continue to monitor it. But if that's the case, banks can generally serve as a pass-through entity where they're not the ones receiving the financial oppression, they're passing it on to their depositors. So banks can ironically do pretty well in a financially repressed environment, especially if they start the period in low valuations. So I actually think many US financials and certain other financials in developed countries are pretty attractive at the current time. I think the end game is major currency devaluation across the developed world, because when you get this high of debt to GDP ratios on the sovereign level, there's really no elsewhere to go other than default. But because the liabilities are in their own currency, the probability of defaulting nominally is exceptionally low. And so instead they tend to default in purchasing power. Again, whether that shows been CPI inflation or asset price inflation largely depends on productivity. If you have massive productivity gains from AI and you keep energy flowing and all that, then, bonds might still buy the same, amount of kind of textiles and electronics and software and, services, but they might buy you a lot less of the highest quality assets out there. On the other hand, if you have energy disruptions or AI is not as productive as many people think, then it can even buy you fewer goods and services. So I think that across the developed world, in addition to financial oppression, in addition to occasional attempts at austerity, it's pretty much going to have to come with a big currency devaluation because they've already made a lot of these errors and there are very few ways out of it other than kind of defaulting through purchasing power. And to some extent, we've already seen that. Like, it's been the worst bond market in modern financial history. You have to go back like a century to find, in the developed world, bond performance this poor. I just don't think it's over yet. Maybe some of the nominal losses are, either over or at least the worst is behind them on any sort of, say, 5-year rolling basis. But in terms of purchasing power compared to the highest quality assets you can own, I think bonds and currency are going to continue to be thrown under the bus for sovereign deleveraging purposes. The key challenge with financial repression is, if you hold interest rates lower than they should be, it opens your currency to a speculative attack. Let's say Turkey, for example, they went this long period and they had very high inflation. They were holding interest rates low. So if you're a global entity, you're like, well, I'll borrow Turkish lira then because they're growing the money supply so quickly. Their interest rates are low. I can buy Turkish lira and I can buy almost anything scarcer than that or anything that gives me a good yield, and it's a good trade. So generally, they combine it with some degree of disincentives or outright bans on borrowing it for that purposes. But then also that also reduces the attractiveness of that market to global investors, because you're like, well, if that market's going to, run financial oppression and capital controls, why would I want to keep capital there? And the biggest countries generally have more runway for getting away with that because there's more reasons why capital wants to be there. Like, all else being equal, capital wants to be in the US more than it wants to be in Turkey. So the US can kind of get away with more restrictions or more, incentives against, like, basically things that make it hard to do a speculative attack against its currency. But around the margins, it's, still there. And to some extent, that's what we're seeing in, like, right now, the big topic in Bitcoin is like these leveraged Bitcoin companies where they just take out debt and buy Bitcoin with it. Because it's like, if you can take out 5-year debt at pretty low interest rates and buy a scarce asset that historically goes up by massive percentages, that's really the same thing as, like, say, borrowing in Turkish lira and buying a better currency with it or buying gold with it. It's kind of the same play. So eventually you might see a crackdown on those types of activities in various jurisdictions, and basically attempts to reduce how much, global capital players are able to arbitrage as currency. But right now, around the margins, a lot of this is pretty soft because it's just inherently harder to do that to the biggest markets that matter.